It's just gone 4:31 in London, and while the last few people are logging on, I think we can start. Good afternoon, ladies and gentlemen, and welcome to the third Fireside Chat hosted by Credo Wealth. Just briefly, for those of you who may not know us that well, Credo was founded in 1998 in London, and we're an independent wealth management business. Today, we have approximately £3.7 billion under advice, management, and custody. We serve over 6,500 clients in the UK, South Africa, and elsewhere. My name is Deon Gouws, and I'm based at Credo's head office in London. It gives me great pleasure to welcome our special guest today. Dawid Krige is the co-founder and chief investment officer at Cederberg Capital. His firm manages $2.3 billion today, and he has managed to achieve a compound return of 18% per annum over the past 11 years. That is in US dollars and after all fees, placing the fund in the top percentile of its peer group. David has 18 years of investment experience. From 2002 to 2004, he was with First Rand's multi-manager division in London, focusing on Asian equity strategies. This was followed by a stint with Mondrian Capital Partners, where he started focusing on China. He has a master's degree in finance from the London Business School, where he participated in the value investing program, and he also has a BCom honors degree from Stellenbosch University, where he graduated cum laude. David, good afternoon, welcome, and very nice to have you on board today.
Deon, thank you very much. It's a great honor.
I've just read out the summary highlights of your career to date, but can you unpack that a little bit more for us, perhaps? It's quite a long way from Linden in Johannesburg, where you went to high school, to Jermyn Street in London, where you have your offices today, and where the smart gentlemen from the city come to buy their double cuff shirts. Journey so far.
Yeah, it has been a journey, but most days I sort of feel like like the sort of Forrest Gump of investment management. I mean, some listeners may remember that film, and some have probably been born after the film came out. But basically, Forrest Gump, not a particularly talented individual, but always sort of at the right place at the right time. They end up him and Lieutenant Dan buy stock in a fruit company, and it turns out to be Apple. And so my career, I think there's been a lot of serendipity, and sort of if one looks backwards, it's easy to connect the dot, but I can assure you the dots. I can assure you there was no master plan. I was very fortunate, I guess, to grow up in a home where investing was discussed, and both my parents are keen investors, and then sort of through Stellenbosch studied statistics there, which I think is a really great background for investing. There are many great ways to invest, many great degrees or not. But and that sort of led me to London, and then very serendipitously, when I left First Rand, I joined Mondrian, and there were two jobs. The one was to this was 2005. The one was to cover China, and the other was to cover European banks. And so, if I would have taken either job, and if I had been assigned the European banking job, my life would have turned out very, very differently. So basically analyzing dinosaurs that sort of slowly are dying out. And of course, China, again, in 2005, no one knew how important, how relevant it would become. I certainly didn't know. And then spent 6-7 years at Mondrian, and then 2011 launched Cederberg, and then sort of it's been a long journey. Lots of it's been a real roller coaster, but a lot of fun.
Oh, that's great. I love your Forrest Gump analogy, and we can talk about that a little bit later when we talk about your running, because just like Forrest Gump, you're a prolific runner as well. But we can save that.
And even my beard is starting to turn into Forrest. My sort of COVID beard. Yeah, thanks.
I thought you're just growing your own face mask.
It's heading that way.
Tell us about the last 11 years. How tough was it to go out and actually start your own business, having been in sheltered employment before that?
It was tough, but I basically just got married, and we went on honeymoon, and that's where I asked my wife. We went to the Cederberg, and that's where I asked my wife, Michelle, sort of, darling, I've got this really great, safe job. Why don't we sort of shelve that and take some risk? And she was up for that. So that was, you know, credit to her. She's been a great partner, for the business as well. Yeah, I mean, those first few years, I mean, it was literally starting with very small, $10 million, sort of friends and family, bootstrapping ourselves. Every year got a little bit easier, but in those first few years, lots of sleepless nights. Yeah, I've got a lot of sort of war stories and battle scars, but when you sort of look back, then you just sort of remember the good stuff.
I think you've just answered my next question as well, because I was going to ask you, why do you call a China-focused fund Cederberg? But I guess it was born out of that honeymoon.
It was born out of that. I mean, practically speaking, and from a sort of intellectual property point of view, no one can go and claim the Cederberg as their fund. So we knew we wouldn't run into any sort of trademark issues. But it's a beautiful place. It's been close to my heart, my family's hearts, and it's off the beaten track. And that's kind of what we're trying to do. We're investing in China, which until pretty recently has been off the beaten track for a lot of people. And the way we invest, we like swimming sort of outside of the, we like to be different to the crowd and swimming against the tide.
We'll talk a little bit more about that later, but can I first ask you, you have teams based both in London, where you are yourself, obviously, as well as Shanghai, where you've got a growing presence. And as such, do you think you were in a privileged position in terms of understanding the lockdowns before we had them in London, given the fact that you have colleagues in China that could share with you what was going on over there as far back as January? So
you're right. We do have, we have 4 Chinese analysts in Shanghai, and then it's myself and another Chinese analysts in London. So we did see things come through quickly. But to be honest, I remember sort of in January, February, telling people like it's probably not going to be a big deal. So we weren't positioned. We didn't take our equity exposure down. We didn't position ourselves for COVID. I think we were very fortunate that the portfolio, which has been consistent over the years, by the way, we invest in domestic consumption companies that tend to be market leaders, and they tend to have very strong balance sheets. And so, yes, COVID has hit China very briefly, quite hard, and now it's recovered very strongly. The domestic economy is at least the consumption business that we invest in. The market leaders with strong balance sheet, they're the ones, in a way, COVID's great for them because they are taking market share from their less well-positioned competitors, many competitors going bust. So that's just, we're just fortunate. I wouldn't say there was any genius in how we were positioned for COVID.
I remember reading your newsletter at the end of February, the beginning of March, where your one colleague in Shanghai wrote about his experience at the time of how it was working with QR codes on his mobile phone in terms of access to buildings, in terms of buying goods and the like. And then interesting also how the QR code changes color if you are perceived to be at risk from the virus, given your past movements and the way that it's been tracked, etc. It sounded like brilliant technology, which I think is ultimately underwritten by market leaders like Tencent and Alibaba. Can you perhaps share a little bit more about that with the audience? And then also, if I can ask a relative question, because we've had talk about a test and trace system in the UK for the last few months now. And only a week or two ago, Matt Hancock basically admitted that we can't roll it out properly in the UK because of technological challenges. So how did China get this right, and how did they get it right so quickly?
Yeah, I mean, the Chinese government sort of, I don't think they get anywhere near the credit that they deserve. They're not perfect by any stretch, but mostly speaking, real technocrats, very competent. And of course, technology, as you've alluded to, the Alibaba ecosystem, the Tencent ecosystem, ubiquitous. I mean, my colleagues can leave home for days without a wallet, but they can't leave their home without their phones, with their Alipay wallets or their WeChat Pay. And so QR codes are sort of everywhere. You can even tip people who street performers or beggars in the street by scanning the QR code. So that's essentially the how the government was able to very quickly utilize those same apps or those same technology. And how it sort of works, say you were on a train or a plane, and it turns out that subsequently someone on that plane contracted COVID. And so your QR code might change from a green to a yellow. And if it turns out that that person sat within a few rows of you, your QR code probably goes to red, which means you can't use a subway, you can't go into offices, or that's no longer the case today, but that's what it was like in sort of March, April. So it's, it's just, I would say, a very scientific, well-developed tracking and tracing system.
So let's turn to the investment opportunity in China, Dawid. I'm aware that a couple of years ago you were a speaker at the Value Investing Conference in London, and you styled your presentation around the 8 myths relating to investment in China. Can you perhaps give us a quick summary of some of those myths, the most important myths? You see it?
Yeah, no, thanks, Deon. I can't remember all 8 of them. I think we probably picked 8 because it's a lucky number in Chinese. One of the myths, for example, is that it hasn't been a good place for investors. That it's not possible to make money investing there. And let's face it, that's what our jobs are, right? Is making our clients money in the long run. And so again, the sort of statistician in me sort of go back, well, what do the numbers say? And it really obviously depends on which period one uses. But if we look at the last 20 years, then China has done about, maybe I'll start with the world, MSCI World has done 5% per annum in dollar terms, which is sort of 4% real or something like that. It's fine. The S&P 500 in dollar terms has done 6% per annum, and China, as per the MSCI China, has done 8% per annum. So 8% is pretty decent. That's about so let's call it 6% real returns. That's what equities have given historically, and I think the future will probably be similar. So that's an example of a myth. And people say, oh, they're just frauds, you can't make money there. But if you just bought the index, you would have doubled your money sort of every 9 years, which is frankly a perfectly good outcome. I think a lot of the myths are, there are a lot of things written in the Financial Times and in the Wall Street Journal and the Economist, and frankly, we're subscribed to all of those publications, and generally speaking, they do a good job. But I always get a sense that there's a very strong anti-China bias, and there's very seldom a bullish case made, and I feel that there's sort of several hundred million people that's lifted out of poverty. I mean, put another way, if I were to take some of these articles that the FT writes about debt and sort of shadow banks and Xi Jinping being in a precarious position because of COVID, and I took those articles to the sort of general public in China, or to my colleagues, or to friends, I mean, they would think I'm an alien. They think, what are you talking about? Your life's better. I'm more affluent than my parents, and in 10 years or 20 years from now, my kids are going to be more affluent than me. So I think the press, unfortunately, do not do a very good job of reporting when it comes to China. And I think there are several reasons for that. But from our point of view, again, coming back to making clients money, that's actually great because that leads to the misunderstandings and it leads to people sort of being scared of it and neglecting it. And if one has the expertise and one has boots on the ground, as we do, then it actually makes our job a little bit easier.
Thank you. One of the specific myths that you did highlight at the time related to people focusing on the macro and essentially getting the macro picture wrong. And you referred inter alia to Gordon Chang's book, The Coming Collapse of China, which was published in 2001. And I want to quote you just one line from a book review in the New York Times shortly after publication. It reads as follows: as Chang discovered, China is a nation of contradictions. Many of its state industries are virtually bankrupt. Its banking system sits on a mountain of unrecognized bad debts. Its agriculture is primitive, pollution is out of control, and government interference and corruption are killing off a number of new business ventures. Would you care to comment on Mr. Chang's words?
Sure. I mean, there are a lot of words, lot of views that I would probably take the opposite view on all of those issues. Whether it's innovation, there are as many unicorns coming out of so startup companies, unlisted companies with $1 billion market cap or above, coming out of China versus coming out of the US. There are hardly any coming out of Western Europe, hardly any coming out of Japan, and in fact also not too many coming out of emerging markets. So it really is, there are more patent applications in China. China has become the world leader on an annual basis in terms of patent applications. Companies like Tencent, Alibaba, several others are, sort of at the leading edge. Huawei in telecoms infrastructure. So I think that's a very extremely biased, view. So it's bizarre to be, but Mr. Chan still gets invited to conferences. He still gets column inches in the press. I find that remarkable, but I guess bad news sells, right?
I will remind you of the fact that he restated his views in 2011, in 2012, in 2016, and in 2017, and maybe one day some of it will be right. We'll have to see. But the one thing I do want to focus on, which he mentions and which the New York Times review referred to as well, is the debt issue. And you've already spoken about the FT, so if you don't mind, I will quote you from an FT article this year in March, where it states the fact that total debt in China is fast approaching 310% of GDP. China accounts for almost 60% of all emerging market debt. And then it goes on basically to say how unsustainable this is. Is this a problem in your view? And is it sustainable? Is it a problem for some of your companies?
I'd start with the last, because I think that's for us the most relevant, is the companies we invest in. And I would say for our companies, it's absolutely not an issue. The vast majority of our holdings are in a net cash position. In other words, either they have no debt or the cash on their balance sheets larger than the debt. We've got one hotel company that has some debt, which is totally understandable because those are tangible assets, very easy to borrow against them. So I would say in the listed space, last time we ran the numbers, which is about a year or two ago, the average listed American company was 3 times as indebted as the average Chinese listed company. And no one's, there's not that much being written about sort of US debt versus Chinese debt. So I would say for our portfolio and the sort of market leaders in China, debt's not an issue at all. For listed companies, generally speaking, not much of an issue. There is debt at local government level, and so some of that is productive, but there are also definitely bridges to nowhere. And there is also some debt, a fair bit of debt at state-owned enterprises, especially the unlisted state-owned enterprises. But neither of those two things worry us particularly, because it's mostly a case of, so who are the debtors and who are the creditors? They're both state-owned. So local governments and state-owned enterprises, these are the debtors. The creditors are state banks, state insurance companies, state trust companies. So I think, the analogies that we hear about sort of China's Lehman moment, house of cards built on debt, I think those are very far off the mark. Another way of looking at it, and so China's debt to GDP, to put it in perspective, is not far away from sort of very similar to sort of Canada, South Korea, the UK, and it's going to be interesting post-COVID with how much money is being spent, how much debt will be incurred as a result in some of these Western economies versus, say, China, which has COVID very much under control, where those figures end up.
Let's talk about the returns from China. You mentioned earlier that over the last 20 years, the MSCI World has given you 4% per annum, roughly, compound.
That's right. 5% per annum. Yeah.
Sorry, 4 or 5, and China's done 8. I have to say,
right.
It sounds quite boring because your fund delivered 11% just last month after costs. This month, because I know the market is up roughly that. A lot of our listeners will be delighted to know that one of your holdings went up 5.5% just this morning, and that was 10 cents. So the bottom line is, do you think that the Chinese market is perhaps becoming overheated? And maybe you can just give us a perspective on how you see this relative to 2015 and the role of the retail investor in that market.
Yeah, no, that's a good and very pertinent question. In China, the A share, or the onshore listed stock market, so Shanghai and Shenzhen, over 70%, 70%. Are retail investors, and mostly not sophisticated investors, perhaps investors buying a company because they like the ticker. There's a sort of a lot of 8s in the ticker. It's really a lot of people in China view the stock market as a legal way to gamble. So gambling is illegal in China outside of Macau. But it is legal in the stock market, and it's cheaper than going to Macau, because in the long run, equity should be profitable. Obviously, in the long run, gambling won't be. So I think right now there is definitely my Mandarin tutor has been asking me for stock tips. Not a good sign. I think there is a little bit of euphoria developing. I don't think it's nearly as strong as it had been in the sort of July, August of 2015, and hopefully the Chinese government won't allow it to get to those, sort of get the bubble with euphoria to get to that level. But it's suffice to say we're keeping an eye on that. But much more importantly, we're looking at the fundamentals of our holdings, and on that basis, we're still quite comfortable at these prices.
I don't think you should worry too much when your Mandarin teacher asks you for stock tips. I think you should start worrying when he starts giving you stock.
That's probably going to be next week. Things happen quickly there.
How is your Mandarin? Are you fluent?
我会说一点not great. I can get by, but certainly not on a professional level.
Can you go into a restaurant and order?
Yeah, I can do sort of restaurants, I can do taxis, I can chat about the weather, I can chat about stock markets a little bit, actually. But the Chinese, people speak incredibly quickly, and so hard to keep up. But it's a labor of love, hopefully, eventually I'll get there.
We're going to talk about your fund in a minute, but maybe one more question just in terms of the bigger picture. China today is the second biggest economy in the world after the US. In fact, by some measures, you can argue it is the biggest if you look at it in a PPP sort of basis. But in spite of that, China is still a fraction of the US when it comes to sort of stock market participation. It's nearly 60% of the MSCI All Country World Index. China is about 5%. So the US is 11.5 times or something like that, China size. Does that make any sense? And how do you see that developing going forward?
Oh, we think that makes very little sense. We think that is sort of a relic from the past. Part of the reason why that index weight is so low at 5%. I won't sort of bore you with the or listeners with the technicals, but it's really MSCI deciding, okay, free float adjustments. They make adjustments for the currency, which isn't freely convertible yet, and so on. But that 5% is going to become 10%, is going to become 20%. I think we can say that with a pretty high degree of certainty. In fact, I wouldn't be surprised if we, Deon and you and I, sort of have a reunion in 20 or 30 years from now and see where things end up. But I wouldn't be surprised if in 20, 30 years from now, it's sort of a third US, a third China, third everything else. If we think of how many unlisted companies are, the likes of ByteDance, which is a $200 billion unlisted Chinese company, that's going to come to the market. And Financial, which is Alibaba's fintech subsidiary, that's similarly to 200. I read this morning they're preparing for an IPO, $200 billion market cap. All the unlisted state-owned companies that are going to come to the market, or the listed state-owned companies. It's like a company like China Mobile. Its free float's only about 10-15%. The rest is owned by the state. Eventually, all of that's going to be, the state will incrementally reduce its stake. Very committed to reforms, but in an incremental, slow fashion. So it's quite conceivable to see that go to 10, 20, even 30% in the long run.
Let's turn to your fund. Now, the first thing that I find very interesting is that you have a warning in bold right at the top of your monthly fact sheet with the heading, "Why Cederberg is not suitable for everyone." And then you list 6 bullet points, including points that mention the fact that declines of more than 50% in the Chinese market are to be expected, and also that you should only consider investing this fund if you have a horizon of at least 10 years. You also have quite a chunky minimum investment level of $100,000. So I think the question that comes from this, no doubt performance has helped. I understand that part. But how have you managed to grow assets under management to $2.3 billion in about a decade, in spite of all these health warnings and making it so difficult for people to get into the fund?
I think that the health warnings isn't some clever marketing ploy. It's really because we believe it's not appropriate. It really, we think China is a wonderful place to be a long-term stock picker, to be a long-term investor, but it is not for the faint of heart. It's incredibly volatile, as mentioned. Over the last 20, 25 years, there were 3 declines greater than 50% in the index. So it really requires investors who are able to take a very long view, don't get heartburn, sort of a look, oh gosh, things are down 10% today. That's going to happen. That's a given. It's a matter of when, not if. But if folks can go the distance and just sort of put things aside, we think there are definitely opportunities. And hence the $100,000 minimum. That's really just to ensure that it doesn't go to a retail audience. The scaling the business, it's taken time, as that sort of the old cliche, an overnight success, 10 years in the making. It was really the first 5, 6, 7 years where they were a hard slog, and then the last 2, 3 years, things have changed significantly for us, and that's mostly come from institutions. And so we've got some great clients, great partners from all over the world. Lots of them institutions, whether it's endowments and foundations in the US or other parts of the world. So really because our clients take a 5 to 10 year view on their investment with Cederberg, that means we can take a 5 to 10 year view on the things we buy for our clients. That's a luxury that very few of our peers enjoy. So the average holding period for onshore investors is between 2 and 3 months, and even the onshore institutions similarly, they are given money by typically a high net worth or a retail client that wants returns within 3 months. If you can't deliver returns in 3 months, the plug gets pulled. So our peers there, many of them are incredibly talented, extremely hardworking, well connected, but it's virtually impossible to consistently generate returns if you're only given 3 months to prove yourself.
Indeed. What's perhaps even more interesting is that you also recently closed the fund at the beginning of the year. Why did you do that? Do you see capacity constraints in terms of some of your investable universe?
So yeah, so the policy where we are right now, existing investors can add to their investments, and if we new investors can come in if there are substantial withdrawals. We did actually have some COVID-related withdrawals, so there is a window right now. But I guess taking a step back, or to answer your question, why did we do this? It really is to try and ensure, to the extent that we can, decent long-term client outcomes. Now, our industry, there tends to be a negative correlation between assets under management and returns. So a lot of folks generate great returns when they're small, but then that attracts capital, attracts inflows, and those inflows, that money can become a huge anchor to returns. So our ambition, I guess, is we want to turn 2 billion into 4 billion, into 8 billion, and so on through compounding. So today we don't think, we think $2.5 billion in AUM. We're very comfortable running that. But it's what happens in 5 years from now? What happens in 10 years from now? So we were trying to be sort of proactive about managing our capacity.
As pointed out in one of the points in your health warning, the fund is also more concentrated than, frankly, I think anything that I've seen in my own investment career, which is now about 25 years. You have only, I think, 17 holdings, if I'm correct. And the top 10 makes up more than 80%, something like 84%. So the question is, how do you sleep at night with such high levels of concentration risk?
Well, if you were to ask Charlie Munger, I mean, Charlie Munger obviously famously said, a 3-stock portfolio is a well-diversified portfolio. And a friend of mine actually had dinner with Charlie at his house recently, and in that conversation, Charlie said he was actually wrong. 2 stocks, that's ample diversification. So that's sort of the extreme school. I wouldn't recommend that. That's something that we're not brave enough for that. But I think the benefits of diversification beyond sort of 8 to 10, 12 companies, they tail off very, very significant. And Buffett sort of said that risk is doing what you don't know what you're doing, or owning what you don't know. And so by really focusing on things that we think we understand, and a manageable number of securities that we can track, I think it actually makes our lives a lot easier and ensures focus. If we're only looking for 1 or 2 or at most 3 ideas a year, the bar is pretty high. So that forces us to stick with our great ideas as opposed to our good ideas. I think oftentimes as investors, we can feel like sort of kids in a sweet store, or like my children in a sweet store. It's just so many things to look at, so much that's exciting. Or look at this, look at this thing, look at that thing. But because the bar is so high, we already really like what we own. Any new name to come in, it's we don't want 10 to become 15, to become 20, become 40. That's very, very easy thing to happen. No, we really just want to focus on roughly 10, at most 15 or so names.
Let's talk about 1 or 2 of those names. And I'm going to start with the one which I guess the audience knows best. That is Tencent. I heard an interview that you did a few years ago where you actually expressed a little bit of discomfort about Tencent, in the sense that you said that the margin of safety, which was the difference between essentially the intrinsic value as you see it on the one hand, and then the share price on the other hand, was lower than what you would prefer. But what gave you comfort was the fact that that same intrinsic value was growing at a very healthy clip at the time of something like 30% per annum. 3 years later, do you still see it like that? How optimistic are you about Tencent today? And as I said this earlier tonight, Tencent went off 5% just today, so that makes the question particularly pertinent.
We're still quite optimistic, Tencent. I think if we, the last 3 years has been quite a ride for that company. I think sentiment has gone from probably quite bullish back then to sort of rock bottom in 2018 to very bullish, or quite bullish today. Mr. Market, it's all over the shop. the 30%, but we still see upside to intrinsic value for Tencent. I think, on our numbers, it's probably trading at around 80 or 85 cents in the dollar of intrinsic value. But that 30% seems quite high. I think that historically that was certainly what the company delivered, but now it's becoming much harder, because the base is much, you're 30% over 3 years. That's more than a doubling of compounded, more than a doubling of the base, right? So the base is much higher. I think ByteDance has been a pretty aggressive competitor. So ByteDance is the company behind TikTok, which I'm sure some listeners. I hear there are a lot of a lot of people who spend hours and hours on TikTok. So ByteDance has taken a lot of traffic from them. They've got competition. It's not, China is in many for many industries the most competitive place on earth. There's a ruthlessness to competition there. So I would say, yes, we are positive Tencent's prospects, but I think high teens, perhaps 20% of sort of compounding of that intrinsic value, it probably seems more realistic.
I want to read a line to you, which is in your newsletter, which I received just a couple of days ago. It says the following: Tencent now trades at 36 times next year's expected earnings, though on a normalized basis, it is much cheaper, given that ongoing investments in cloud and fintech are temporarily, that's a big word for me, depressing margins. So you mentioned cloud there. You also mentioned Alibaba and its cloud business in the same newsletter. Can you perhaps just comment on the importance of cloud for these two companies and generally speaking in the Chinese market?
Alibaba, so Tencent and Alibaba are of a similar size, give or take 500 billion, maybe it's 600 billion of market cap. But Alibaba's cloud business is about 3-4 times the size of Tencent's cloud business. Now, if we think of the DNA of these two companies, Alibaba has always been a B2B business. Alibaba's customers aren't the hundreds of millions of people buying stuff on Taobao, Tmall, its e-commerce properties. Alibaba's customers are small, medium enterprises, are brands. Alibaba, and so from day one, they were very focused on the corporate customer. So it's more of a B2B business. Whereas Tencent, from day one, has been more of very much a consumer-facing business. So what we could say a B2C, a business to consumer business. And I think that's sort of reflected in the way they have what they've entered, what they've invested in over the years. So Alibaba was much earlier in cloud than Tencent. And these are enterprise customers. Cloud customers are, by and large, it's a big bank, or it's another software company, another internet company, an online video company, what have you. So Alibaba has definitely been focused much more. But even for Alibaba, the cloud is more important. On our intrinsic value estimates, the cloud business is only about 10% of our intrinsic value estimate. So yes, it's growing very rapidly. Yes, it has a very bright potential, bright future, but it is sort of dwarfed by this e-commerce and other parts of Alibaba's business. And for Tencent, that would probably be even more so. So it's quite different to say an Amazon, where Amazon's AWS, its cloud business, is a very, very big part of the valuation. Even as high as 50% or more on some analyst estimates.
Although that really only happened in the last 3 to 4 years, that it's become so big. So who knows how quickly it can happen in the case of Alibaba.
That's right. China's sort of interesting in that sense that historically folks, historically people, whether it's individuals or companies, they don't want to pay for software. And so they don't want to pay for cloud. I mean, we've visited, we've done company visits, big listed companies in China, and they sort of project, what you think is Excel on a projector, and you look closer, it's like, that's not Excel, It's some local pirated copy. So, so I think that willingness to pay We've obviously seen it with consumers. There's definitely a willingness to pay as they become more affluent. It's not just people are buying real Gucci bags or real LV bags, and I think we'll see the same thing with businesses, with enterprises, but it won't happen overnight.
Another favorite stock of yours, which you actually pitched to the Value Investors Conference in London 2 years ago, is Quattro Mutai. Now, this is, of course, a bit different to Tencent, and I think most people in the audience don't know it that well. Although it was recently featured in the FT under a headline that it's Chairman Mao's favorite spirits brand. Now, this company, in one of your newsletters, you said, is up more than 13 times in the 7 years that I've owned it. And it's also up more than 10% just in the past week. I saw yesterday it's now one of the biggest 20 companies in the world as measured by market cap. Can you perhaps tell us a bit more about the company, its products, and why you like it so much?
Yeah, so I've actually got a bottle here. I don't know if you can see it or viewers can see it. This is a 500 milliliters liter bottle of its flagship product. This in China sells for about 2,400, 2,500 renminbi. Let's call that 300, 350 US dollars. Very expensive, especially considering it's not really much to look at. But this is really China's only sort of homegrown luxury brand. Its origins go back 400 years. It was consumed by the Red Army in the sort of the Long March in the sort of 1930s, 1940s. Soldiers, all these stories, which is very common to luxury brands, right? It's in the UK. Here in Jermyn Street, if you walk, you'll see by a royal warrant or by appointment to Her Majesty the Queen. So perhaps Daniel or whoever 200 years ago was a tiny little one-person shop, but they used that story, that legacy they used that story to build something huge. So storytelling, I think, is very important in luxury goods. Malta has got wonderful stories. If you Google Malta, you'll see pictures of sort of Kissinger drinking it with Mao, with Nixon. Sorry, Kissinger drinking with Mao and Zhou Enlai. You'll see Xi Jinping. He drank it with recently with Vladimir Putin. He had some with David Cameron, sort of 2 prime ministers ago. So since Mao, every Chinese leader has drank Mao Tai publicly. So it's a 400-year-old brand with 99% aided brand awareness. So if we ask 100 Chinese people across all demographics, whether they drink, don't drink, doesn't matter, rich, poor, 99 out of 100 would say yes, I know Mao Tai. So it's like Coca-Cola in that sense. So there's really nothing like it, and it's a virtual monopoly. And if you want to impress your father-in-law, or if you want to get the deal done, this is what comes out. If you've got a new employee or joining, or if you're getting married, or if you want to celebrate something, this is, you can't go wrong with this stuff. It tastes pretty good, actually.
Let's hear. Can we talk about a stock that you didn't own, and thankfully you didn't own it? That is Luckin Coffee, something which has been in the news this year. It's been a market darling since it listed on the NASDAQ 18 months ago. And a few months ago, it admitted that overstated revenues, which meant that their market cap went from something like $12 billion US to a number 95% lower. Now, I'm aware of the fact that you did actually consider investing in the company, but you decided not to. Can you share that experience with the audience, please?
Yeah, sure. So Luckin Coffee was only about 2-3 years old. They portrayed themselves as the Starbucks of China. There are lots of beverage companies here. We've looked at an alcoholic beverage, but if you think Coca-Cola, if you have that combination, or Starbucks, you have that combination of sugar, caffeine, and a brand, and that can create massive customer stickiness. Red Bull is another example. Coffee chains all over the world. So Luckin Coffee had ambitions to become, to open thousands, tens of thousands of stores. And so we were drawn to the story, but as we started kicking the tires, speaking with former employees, analyzing the track record of the founders, we became very worried.
That's good to know, and your investors, I think, are thankful for the fact that you didn't fall for the scam. But more generally, David, I want to ask you a related question, and that's about accounting numbers coming out of China, because I think a lot of people are simply skeptical about it, and that's one of the reasons why it's holding them back from investing in the country. Is this something which has been problematic to you in terms of analyzing companies?
Look, all the big four, they've all signed off on fraudulent financials, and that's true whether it's China or we've had Wirecard in Germany, obviously in South Africa there've been examples, here in the UK examples. So in China we assume guilty until proven innocent when it comes to the financials, when it comes to a company, whether it's Luckin Coffee. And it doesn't really matter whether it's a mega company. Luckin was a big company, 12 billion market cap. But whether it's a huge company where we've got KPMG or Goldman Sachs or whoever doing the research and vouching for the company, or whether it's a small company, we're going to assume we can't trust the numbers. I don't think it is as bad as a lot of people think. I mean, China, you've got a sort of Chinese companies are listed on lots of different stock exchanges. So a lot of them are listed in the US. Some of them are listed in the offshore, other offshore markets like Hong Kong or Taipei. But then most of them are listed onshore, the A share market. And in the A share market, there are actually very few frauds because the penalties are so severe. I mean, if you commit fraud on the mainland and you sort of defraud Chinese investors, you will go to prison for a very, very long period of time. If you sort of defraud investors in Hong Kong or investors in New York, and you've cashed out and you've bought a mansion in Sydney or Vancouver, chances are nothing's going to happen to you. So, but I guess the point we're trying to convey is China can be a dangerous place to invest, and we haven't had any fraud or corporate governance blow-ups in the 15 plus years that I've been investing, but there are plenty of landmines that we've dodged.
You talk about mansions in Sydney and Vancouver. I thought you were going to add Hermanus to that, but maybe that's a topic for Do you have any thoughts on the trade war playing out between the US and China, or is that part of the macro that you simply ignore?
We're quite fortunate that we don't have to spend too much time thinking about that because, as we've discussed, we're very focused on the domestic consumption. I think the trade war and just more generally speaking, there's sort of fractious relationship between the US and China is probably going to, be a multi-year thing. It seems as if things have escalated. It's not in the American citizens' best interest and not in Chinese citizens' best interest. But I guess it's sort of inevitable if you have these two superpowers. The one, the former, the 20th century being the American century, and maybe feeling a little bit vulnerable for a variety of domestic reasons. And whereas you have this new superpower, 21st century. It's the Chinese century, it's the Asian century, it's China, it's India, it's Vietnam, Indonesia. I think that's where the growth is happening. That's where the people are. And they are, speak to a Chinese person, they feel they rightfully, after sort of 200-300 lean years, it's their destiny to again be the most prosperous or the biggest economy in the world.
But maybe a related question, whether it's the trade war or whether it's something else, maybe it's the post-COVID dynamic. We saw in the last few months huge problems with supply chains coming out of China, where a company like Apple, for example, couldn't source its own product from its own factory in China. And that, according to some analysts, will lead to so-called reshoring, taking jobs and opportunities and ultimately economic activity away from China back to the US and elsewhere. You see that as a risk?
I think it's a very minor risk. I think depending on the industry, it's incredibly difficult to reshore, to move whole ecosystems. I think that's that's the thing that people perhaps underestimate about China, is that it's not just the fact that there's cheap labor, because by the way that those wages are growing at 10%, so the wages aren't all that, and that's intentional. China doesn't want to make labor intensive toys and furniture and t-shirts. They want to make want to be artificial intelligence or 5G or experts, or make passenger, jets and so on. So, but it's the combination of all these factors. Great infrastructure, so ports, roads, railway, electricity is pretty low, and the fact that all these component makers, they're already there. So it's about speed, it's about convenience. Incredibly difficult to do that. I mean, a recent example was Japanese government offered Japanese companies with plants in China huge subsidies to bring their plants back to Japan, and they turned the money down. They said, we can't do it. It's not worth our while. So I suspect there will be places like Vietnam and Southeast Asia certainly will net on a net basis be beneficiaries, but I think it's going to take a long period of time, and I think it's going to be very hard. And I suspect the vast bulk of the manufacturing that's done in China today will still be done there in a few years from now.
We're coming towards the end of our conversation. There's only time for a couple more questions, really. And I do want to talk about Hong Kong, because we've seen a lot in the news in the last few weeks about Beijing clamping down on Hong Kong. You've clearly been to mainland China and to Hong Kong multiple times in your career. How do you see that whole scenario? And once again, is that of concern to you from an investment point of view?
Yeah, no, Deon. Again, from sort of making our clients money, from looking at the fundamentals of our companies. Hong Kong is about 3% of the Hong Kong economy, is about 3% of the GDP of China. So it really is very, very small, and none of our companies are particularly reliant on Hong Kong. So we sort of follow what's happening there. I think some people have very strong political views on what's happening. Again, our job is relatively simple, because Hong Kong and what's happening there is really not impacting our holdings.
There's one question from the audience which I'm going to read out verbatim, and it comes from somebody who I happen to know is an investor in your fund. The question is, do you see any benefit to your portfolio from the Belt and Road Initiative? And maybe just before you answer that, maybe in 1 minute, you can explain to those in the audience who are not too familiar with Belt and Road just what's meant by it. And
so it's sort of a mouthful. It used to be the One Belt, One Road. Now it's just the Belt Road Initiative, and essentially it's China sort of recreating the old Silk Road, which were links with trading partners. And so it's a little bit confusing, because the road actually refers to a naval passage. So naval links or maritime links, and the belt is overland. So one could take a train from sort of Shanghai to Paris, and so road and rail linkages with Central Asia and even as far as Europe. I think Belt Road gets a lot of bad press. I suspect that the Chinese, in typical Chinese fashion, are playing a very long game. I think it's way too early to conclude whether this is going to be a success or not. And one thing the Chinese don't have versus the Americans today is soft power. I think the combination of that sort of, the American dream and Hollywood and all this stuff, the language, it has a huge amount of soft power. And I think China craves that, and it's focusing on emerging markets mostly as coalition partners, if you like. So, I think Belt Road, let's see what happens there. As far as we're concerned, in terms of our portfolio, again, virtually no impact.
On a slightly more personal note, do you mind me asking what makes you tick? I've mentioned your running earlier. I know that you're a 3-hour marathon runner. But what else? What makes you tick?
The running. I love running. I think it's sort of as the as the bumper sticker goes, running is cheaper than therapy. A friend of mine is like, "What are you running away from?" I was like, I don't understand. I love it. It gives me a lot of endorphins. I actually ran into the office, and I'm probably going to run home after this call. I love reading. I'm a bit of a nerd, so I'm very happy to just be in a corner with a stack of books. I've recently actually picked up some fiction, which I'm quite enjoying. I think there were several years when I didn't read a single novel, so it's actually quite nice to read some fiction. But yeah, I think sort of, pretty big nerd. Go to bed at about 9 o'clock and wake up very early, and sort of just like to read and run, and not exactly the life and soul of the party.
So give us some reading tips. What's the best or most important book that you've read, one that springs to mind?
So I was thinking about this actually, and I think that I think the only book that I've read more than twice is Thinking Fast and Slow by Daniel Kahneman. And it's basically about behavioral finance or behavioral science. And so all these irrationalities that we have in ourselves, the human beings, even the most rational human beings, are actually extremely irrational and make decisions for all sorts of weird reasons. That we and what's interesting is Daniel Kahneman has been studying this field, behavioral economics, for 40 plus years, and he said that despite those decades of research, he thinks he's just as irrational today as what he was, in sort of 40 years ago. And so that's like a very good reminder, because sometimes, my background is statistics and I've, left brain, and I think of myself as very rational, but I'm not. And I think reading that book, and I sort of try to read it every 2-3 years, reread it, just like a good reminder for myself, all my heuristics, all these sort of rule of thumbs that are actually can be quite unhelpful in life, and certainly in investing.
But we've basically run out of time. And in closing, I'd like to quote from your newsletter at the end of February, where you said the following: keep your eyes on the horizon. In a year or two from now, these events, and just to interrupt myself, this was the time when COVID was just taking hold in the Western world. These events won't matter much. If you own a portfolio of strong growing companies at reasonable prices, the best is yet to come. Or to quote Bachman Turner Overdrive, you ain't seen nothing yet. As a parting thought?
Now I think you've given all the listeners an earworm. Like that tune's going to be spinning. Yeah, I think the emphasis there really on, if you own a portfolio of wonderful businesses, then you can sort of sleep well at night. Yeah, I think if one owns a portfolio of very average or below average businesses, then they look at that. They all will have their sort of their brief periods of brief glory, but really, I think I just find the older I get, the more I'm about simplify. And I think if you own wonderful businesses, you're actually making your life very simple, because they are doing the hard work for us. Like Daniel Zhang at Alibaba, or Pody Ma at Tencent, or Zhang Yong at Haidilao and Ehai. These guys, they're doing the work. We're just making a decision, which is, wow, this is a great company and it's quite reasonably priced. Let's buy it, and then own it for 7, 8, 10, ideally longer than that. Whereas they are the ones up at night thinking about how to create value.
Thank you, David. That was most enjoyable and informative. All I can say on behalf of the audience is keep up the good work and all the best.
Thank you very much, Deon. It's been a lot of fun.
Thank you. All that remains for me, again, as we do always, is to invite all members of the audience to go to your kitchen, find your best bottle of wine, and pour yourself a large glass with the compliments of Credo Wealth. Until next time, goodbye.